And good afternoon. Welcome to the Price Group monthly market update. Hard to believe it is August, but the good news they tell us football season is coming and some of the hot weather may be leaving us. But anyway, this is our attempt on a monthly basis to provide some perspective, some education, and some interesting information that will help assist you as far as feeling good about what you're doing. We talk about clarity, talk about comfort, and we talk about confidence. And again, more information typically is always better as we do this. We'll typically get through this in about 15 or 20 minutes, being sensitive and respectful of your time. And we have room at the end for questions. If you have so, just go in and in the chat box, give us your question, and we'll make sure to address those. Or feel free to email us, and we'll get back to you with a phone call or email at a later date. Moving on to the next slide there. Who are we? We are the Price Group, 50 years of experience. We follow a fiduciary standard, and today Matty and I will be driving the boat and handling the information. We work with folks that are either retired or retiring. 83% of our clients are actually, I'm happy to report, are retired.
Thanks, Randy. I get to brag on Randy and Matt a little bit, and on our team. Randy and Matt have been recognized by a number of publications over the years: Barron's, Forbes, Financial Times. Earlier this year, Randy was named to the Best In-State Advisor list again. Matt again was named to the Next Gen Advisor list. We also think education is very important in our industry. All three of us have our CFP, Certified Financial Planner designation. Matt and Randy studied at Wharton for their CIMA, Certified Investment Management Analyst designation. Again, we think education is very important. A little bit more about our firm. Sometimes clients ask us or people ask us, who is the Price Group? What's Stewart Partners? Where does Raymond James fit in? The Price Group, Randy, Matt, myself, our team, we serve as the Houston office of Stewart Partners, our firm, based on the biblical definition of stewardship, 30 billion of assets as of the end of last year. Raymond James serves as our primary custodian, where client assets are held. They've been a great vendor, a great partner of ours for the last 6.5 years.
Let's talk a little bit about thank you, Matty. Talk a little bit about the economy. You hear folks talking about the quote unquote coming recession. And the problem with the recession, as we've said many times, is it sounds like that dreaded word depression, but a recession can be mild, it can be moderate, or it can be severe. A lot of people think back to the 2008 recession, where things really, because of a number of different reasons, it was a hard landing, if you will. It was a more severe recession. But by definition, if you have 2 straight quarters, 2 3-month periods where the economy doesn't grow, it shrinks just a little bit, you're in a recession. Not a huge deal, but anyway, a lot of these really smart people that are economists track that. And you see a lot of different opinions out there. We're going to have a soft landing. We're going to have a hard landing. We would be in the group that would say the economy is softening, but not collapsing. Labor market remains healthy. Services remain in an expansion mode. Mortgage rates going down. I just quoted mortgage rates for a 7-year adjustable rate mortgage this morning at 5.25%. So those are down, and I talked to the mortgage person, and they're starting to see some refinancings from when their mortgage rates were up in the 7s, et cetera. So it's the lowest level since about over 2 years ago. Credit card spending isn't collapsing. Gasoline prices are a little bit lower, and capital spending from the corporations are higher, and of course, bottom line government spending is higher. How about that? But anyway, so our forecast for the gross domestic product, the sum of all the goods and services right there for the fourth quarter. For the second quarter, 2.8, and then the forecast up about 1. Again, softening but not collapsing. Probably the second thing people ask about is, what about that Federal Reserve? What will the Federal Reserve do as far as interest rates? Well, let's go back just a little bit in history. We had literally zero interest rates because of the Federal Reserve for a long time. Money market made no interest. And then the Federal Reserve said, whoops, we got inflation. Imagine that. And so they started raising rates, and they raised rates, if you will, quite a bit, to where now, if you're in the right place with our cash management account, you're earning over 5% on your idle cash. And so looking here at history, you can see that there's been at times where the Federal Reserve has raised, and there's times where the Federal Reserve has cut interest rates. Obviously, when they cut interest rates, that's try to stimulate economic activity. And that's where that soft landing comes in. The Federal Reserve wants to slow the economy down, bring it down softly, but not have it just fall out of the sky and hit the ground. That first cut, and people are debating on actually when and how much, is expected during the month of September. Where it goes from there, we shall see. The Fed always talks about being data dependent on some of their policies and their cuts. Whether they cut 1/4 of 1% or 1/2 of 1%, we'll see. Further sort of complicated or made interesting, or both, by the fact that this is an election year. But we think, and we're on record as saying, 5% money market could soon go away and become 4% money market, which could become 3% money market. But anyway, stay tuned. But anyway, there are by many people 4 to 5 cuts expected. A couple of weeks ago, we had a very difficult period where we saw a lot of volatility in the marketplace. Didn't get a lot of press coverage, but we think here at the Price Group that there was some real worry about war in the Middle East, and the press talked about some other issues. But to put the equity pullback that we had in perspective, what we saw and what we think we will see going forward is not unusual. You can see the chart on the left talks about there's an average of almost 3.5, 5% pullbacks per year. So far in 24, we've had 10% pullbacks, average one a year. We haven't had one yet in 2024. Actually, we don't have a slide on this, but there's typically a 20% pullback on average every 3 years. But the maximum intra-year decline, again, average versus what we've seen in 2024. So you would say, wow, it sure looked horrible. Yeah, maybe kind of, because we've sort of gotten used to it not happening. But historically speaking, we were right in the norms. So are we positive? Are we negative? Are we neutral on the equity market? We go through here reasons we remain optimistic on the equity market longer term. Obviously, short term, flip a coin, who knows? But longer term, the market becomes much more of a valuation machine, if you will, and makes more sense. The Federal Reserve cutting interest rate, always supportive of that, and we've drawn the line there, the date of the first cut. Earnings on corporation, when you get right down to it, the value of a company is the present value of future earnings of a company, what they can earn. And that's why we love dividend stocks so much, because one of the signs of a healthy company is a dividend that's just been paid. And last but certainly not least, there's a record amount of cash on the sidelines, $6.1 trillion, and that keeps going higher. So we are optimistic. You've got to be selective. You've got to be process driven. And we think, again, if you're anywhere close to retired or being retired, that you ought to start emphasizing some dividend paying stocks.
And while we are optimistic long-term on equities, like Randy talked about, we know there will be pullbacks. just like we've experienced earlier this month. And we believe for our retired clients that we can win by not losing. So what does that mean? In 2022, round numbers, S&P 500 was down 20%. You can see in the highlighted example here, if your portfolio was down 20% and you're taking out 4%, withdrawing 4% per year from that portfolio, what this shows is that you don't just need 20% to get back to where you were. You actually need a 36% return just to get back to break even. And so that's why we think it's really important to know what you own, why you own it, how much risk you're taking. A big part of our investment process of winning by not losing, and let's not take the risk that maybe we've taken historically in our working years. Maybe we take less risk in retirement, mute some of the downside so that we can produce the necessary income for those 4% distributions. And to that end, we think dividend income really matters in retirement, owning dividend paying stocks that are increasing those dividends. Here in this chart, the gray bars are the total return in a given period, so a given decade, appreciation plus dividends or income. The blue bar is the dividends contribution to that total return. And what you can see across the decades is that dividends have been a material contributor to total stock market return. Some decades more than others. Look at the 70s, 73% of the total return was attributed to dividends. Some less so. The figure is a little bit more muted when the market does well, like you see in the 2020s. But one could make a compelling argument that the next 10 years, the stock market may not be able to do as well as it has in the last 10 years. And if that's the case, we really think dividend stocks could be a great place for retirees to hang out. If stocks are moving sideways, the dividend income is reliable and consistent. Randy, anything to add there on dividend income?
Yeah, I think you make a great point there. Remember the stock market here, especially recently, has been driven by what we call that Magnificent Seven, or the big tech stocks, the Apple, the Microsofts, the Nvidia, et cetera. And although some of those pay a smaller dividend, we've had the market favor mega stocks that were not dividend paying. So I think we get a little bit of a lesser contribution by dividends so far, just by the way those stocks have reacted and done so well. But yes, we think that is one of the, if you will, the secret sauces that we have. We love dividend stocks. They're a great multi-generational planning vehicle, and again, typically, historically, have shown less risk in the overall market. So when you're retired, more income and less risk are typically two things that really work well in tandem to help you feel good, sleep at night. Clarity, confidence, and comfort. So that is the end of our prepared remarks. So we certainly appreciate your time joining us, and hope that you'll come back. Feel free to reach out to any of us. There's the picture. There's Preston, Tiffany, Matty, myself, Matt, and Melissa. Phone numbers, email address is there, and we're here, and certainly appreciate again your time, your interest, and would welcome any comments or feedback that you might have. So have a great rest of the Thursday afternoon. Stay cool, and remember, as we say, everybody needs a wealth coach.